So welcome everybody to the Hive Business Tax Masterclass. I'm obviously Hayley, and the other person you should be able to see on the screen is my colleague Simon.
Hi there.
So I just wanted to start by giving you a little introduction. To Hive, our philosophy, for those of you that don't know about us, and also to myself and Simon. So I've worked with accountancy firms over kind of 10, 12 years now, and I always kind of felt like I was quite limited in what I could do. So it kind of tended to be preparing a set of accounts, picking out the viewed non-tax deductible expenses, calculating usually quite a substantial profit for dentists, and delivering kind of a nasty tax bill. So the advice was quite narrow in how we could apply it. It tended to be looking back at the previous year, maybe suggesting a pension contribution, which of course does save tax, but it also means that the client's cash is still locked away. So I kind of felt like I wasn't adding very much to my clients' world and kind of improving things for them. So myself, Simon, and another colleague, Ross, formed Hive about 5 years ago. So we are a multidisciplinary firm. We are chartered accountants, so we do not only compliance work, but we also work solely with dentists. So we provide kind of more detailed industry-specific financial analysis, specialist tax planning. We've also got a full marketing agency and a consultancy department too, solely focused on dentists. So myself and Simon are chartered accountants. Simon is also a chartered tax advisor. So he spends a lot of his time working with dentists. He recently designed a product that helped save one of our clients £200,000 when he sold his business. So he's going to be talking to us about the kind of more complex areas a little bit later. And at the end, there will be time for questions, but obviously understand that finances are quite personal. So feel free to drop myself or Simon an email following this, and we're quite happy to arrange one-on-one conversations with you. Okay, so if we move on to the itinerary for this afternoon, we're going to start off by looking at your overall tax strategy and how best to structure things. We're then going to move on to, once you've got your structure in place, what you can do to make sure that's running efficiently and effectively. We're going to look at optimum income and profit levels. I'm going to touch upon how Hive can help if you're buying a practice or maybe selling your practice in the future. Simon's going to touch upon some aspects of property tax planning, and also how group structures can help in different scenarios. And then we're going to finish up by looking at some other taxes that may affect you, and some changes that might have already happened in the tax landscape or are on the horizon. So I think the first thing to mention with tax strategy is, unfortunately, there's no magic wand. We're having to work harder to get tax savings than we ever have done. And given recent events, that's only set to get worse. So there's been a number of changes in the tax landscape over the past few years, quite wide-reaching. And HMRC have done quite a good job in maximising the revenue that they're collecting from clients or our clients. So the kind of historic tax planning, such as looking back at previous kind of what had happened and applying something, kind of doesn't cut it anymore. We have to work harder and be smarter with how we're doing things to get those tax savings, but they are still there to be had. So my number one piece of advice is, if you aren't already trading via a limited company, and then to do so as soon as you can. So if you're an associate, it's quite a straightforward process. A little bit more complex if you're a practice that's operating as a sole trader, but definitely can still be done, and it's something that we do a lot. So what is a limited company then? So this slide hopefully demonstrates some of the differences between the sole trader and a limited company. So on the left-hand side, we've got the normal simple sole trade structure. So an individual will earn a profit they will have a tax amount calculated on that profit. They will pay it over. They'll be left with some funds left in their pocket. So quite simple, but very inflexible. There's kind of very little you can do other than pension contributions and making sure you claim everything you can to reduce the tax burden as a sole trader. So then a limited company, and the first thing to note is that it is a separate legal entity in its own right. So it's a separate thing to the individual. So it collects the profit now. So it might be an associate or it might be a practice, but it, in this instance, collects £150,000 in profits. It itself pays its tax bill. So that's corporation tax it pays, and that's at a lower rate of 19%. And then basically whatever's left over within that limited company, we have options with what we want to do with that. So in this scenario, you'll see that there's 122,000 left in that company that we can choose to pay out as a dividend to the shareholder, which is yourself, or we can choose to retain an amount in the company. So in this instance, that individual has chosen to draw out £100,000 in a year. They've drawn that as a dividend. That is now taxable. There used to be a really nice tax break that basically meant there was a certain level of those dividends that you could draw without any further tax. That went in April 16. But as you can see, that person is paying £20,000 personal tax. The company's paying £28,000 corporation tax. So there still is a saving there because the funds have been retained in the company. Albeit they're not in your personal pocket, but they're also not in HMRC. So we also have some options with what we want to do with that. I meet a lot of new clients who are sole traders. They might be associates kind of smashing through the abatement, so they're paying a 60% tax charge. Or they might be practice owners that are generating profits of hundreds of thousands a year that their accountant has basically said, it used to be beneficial to be a company, not so much anymore, don't worry about it. Which if you're looking at very narrowly, so if you're a limited company and you're drawing every last penny out of your company, yes, you will pay there or thereabouts the same amount of tax as a sole trader. But the point is that you have options. You don't have to do that. You might not need all those funds that your company is generating, and they can be better put to better use. So one thing that we talk about a lot with our clients is the sweet spot. And that quite simply is that 100,000 that you saw that individual drawing from the company. That is a very efficient rate of tax, rate of income for tax purposes, because it's just before you tip into that abatement allowance, which basically means you're paying 60%. There is kind of a lower level. So an individual can earn 50,000 and just pay basic rate tax. So if you've got a company with a husband and wife, then that's 2 times the 50,000. So there's 100,000 that you can draw. So if you're trying to cap your personal income and the money you're drawing from that company to a level, you can really make sure that you're making tens of thousands of savings each year. So by keeping to a basic rate tax, you're looking to pay an effective rate of 25. Or if you're a sole trader, that same individual would look at be paying rates of 45, 40% in tax. Now, it's not going to happen by coincidence. It needs to be structured, and you need to keep on top of things. So an individual might have money from their business, but there may be other things in their world that they receive income from. For instance, they may have a rental property and they get rental profits each year. It's really important that's weaved together with what you draw from your business, because it's very easy for you to draw you 50,000 from your business and then you've got 20,000 rental. So that means you've tipped over that sweet spot by £20,000, which has cost you 6k, and there's nothing we can do about that. Whereas if we know about it in advance, we can plan for it, and we can make the two things work together. So with our clients, we tend to, beginning of the tax year, around about now, we start looking at what their personal requirements are going to be for the rest of the tax year. And we look at weaving that together with any other income that they've got, and we set them a set payment structure, if you like. We don't ever, really advise on a fixed monthly payment. from their company. That looks a lot like salary. We don't want to have to defend that to HMRC. So what we tend to do instead is we advise them to take a fixed quarterly dividend. So they know exactly where they are, they know what's coming into their personal bank account, they know what they can spend, and they know what they can save back for personal tax. There might be some people watching that have mixed practices. And it's another kind of common misconception that we hear a lot with new clients is that I've got an NHS contract, so I can't incorporate, so this isn't a valid conversation for me. But that's not necessarily the case. So I'll let Simon explain a little bit more about that one.
Yeah, there's a couple of different ways of incorporating an NHS contract. The main one most people immediately think of is getting the contract name changed, or actually just banking the money into the company bank account. But that doesn't really achieve anything from a tax point of view. It's still your personal cash, and you're still going to suffer those higher personal tax rates. So you do need to look at actually taking some steps to incorporate the contract into the company. There are two ways of doing that. So you can either go to your local area team, speak to the NHS, say, look, I want to incorporate, let's get the contract in a new name, I want the money to belong to the company. And depending on how your local area team react and their view on the whole thing, that could be absolutely fine. But they might take the opportunity to threaten to put the contract to tender, or to change your UDA value or the amount of UDAs. The ball's kind of in their court to say, well, if you want to incorporate, then you accept our changes. That's not always going to be good for you. So the other option that exists is to put a contract in place between yourself and the company to basically subcontract the performance of the NHS contract to your company. Now, that's not the same as just banking the cash there, because there's a legal agreement that backs it up. But it kind of achieves the same result if you don't have the NHS on board. It does require working with solicitors to get a proper contract drawn up and going through the process properly, but it's no more complex than doing the NHS agreement, agreeing it with the NHS if they're on board. So I think that there are always options, and you don't have to take the NHS's no as final, or even think that having NHS is a blocker.
Okay, so if we've accepted that we've got a nice limited company structure in place, the kind of next step is to make sure we're doing everything to run that strategy effectively. So part of that includes working with your accountant. Unfortunately, we're not Mystic Meg when it comes to kind of foreseeing what your personal needs are, what you might have planned in your life. You might have kids that are just about to start private school, so your personal requirements are going to change. We can work with you to do this, and there are tools and ways that we do it, but there does require a higher level of engagement to get the savings these days. So a really good tool that we use with all our clients is cloud-based bookkeeping. So we're an advocate of Xero. There are a number of others on the market. You may have seen QuickBooks Online, adverts on the TV. But basically, it's just a way that we provides more visibility. So there are automated features within cloud-based bookkeeping. It speaks to online banking. There's less data entry. And the whole point of it is to make it as easy as possible so that you're able to keep it as up to date as possible. Your accountant then has a login. We can see interim figures. So we can see if you're earning more profits and perhaps you could draw some more, or we can see perhaps you've drawn some things you shouldn't have drawn that weren't kind of in line with the plan, and we can correct it. But cloud-based bookkeeping won't give you 100% of the answer. You kind of need to own your own strategy. So you need to understand what your strategy is. Are you trying to keep your income to 50k? Is it 70k? Is it 100? And kind of understand why. And then that will allow you to communicate things that are relevant to your accountant. So it might be that you bought that house, and it might be that actually the house isn't making any profit and it doesn't have any impact, but that's kind of where your accountant will come in with their expertise. So it's a bit of both. The other thing is that if something does go wrong, so we were trying to keep income to 50k and we've got to the end of the tax year and we've realised actually it's going to be 70, we're not in the world that we were before. We can't go back and declare a dividend, we took a dividend back then, we didn't take a dividend back then. There's the Criminal Finances Act 2017, which is now in force, which basically makes it a criminal act to go and backdate any paperwork. So it's really important that we're on top of everything and everything is done in real time, and we're looking forward all the time as well. So hopefully you're kind of getting the theme that this strategy is all about making sure things are paid from the right place, and we're paying for as much as we can from the business, and we're drawing as little as we can just to cover our personal expenditure. So one thing that we do with clients also is run through their personal expenditure just to see if there's anything that we can pull out and maybe the business can pay. So with limited companies, we're able to do some family structuring. So it might be as simple as I mentioned earlier, making your wife a shareholder, utilising her basic rate band, or your husband. But if you've got children in, adult children in further education, there is a way that we can structure it so the company can pay dividends or pay a salary to them. So if you're financially supporting them and having to draw X amount out of your company to pay over to them, we can circumvent that and avoid the personal tax on that. There are also ways that your company can purchase transport for you, so whether that's cars or bikes. I'll let Simon explain a little bit more about that now.
Yeah, I mean, obviously electric cars is a hot topic at the moment for a number of reasons. I think if having an electric car and the way they work, and they're restricted mileage over a petrol car and time to recharge and everything, if that suits your lifestyle and the way you use your car, then buying one through a company these days is now just a no-brainer. There's so much tax savings to be had. The cost of the vehicle is tax deductible for the company. Unlike a petrol car, there's no penalty for letting an employee or yourself as a director use the company privately. That could be as much as 30% of the cost of the vehicle. So over 3 years, an electric car can cost you as much as, or as little as, a third of the cost of a equivalent petrol car if you've bought it through your company. And obviously this all helps you hit the sweet spot, because if the company is able to pay for the car and you don't have to pay for it personally, you're able to reduce your personal withdrawals, save some dividend tax, let the company get extra tax savings. The whole thing just the savings just mount up, an absolute no-brainer.
Thanks, Si. The other ways in which a company can improve kind of your financial position, they can you can use the funds within the company to make investments. So a lot of clients will say, I like to have a little bit in an ISA, or I like to invest in some stocks and shares. Your company can make any investment that you can personally, just without incurring the personal tax. And when we kind of have the discussion about ISAs as well, what ISA do you know that will pay you 32.5% interest? Because that's what you're saving by not withdrawing those funds to put in your personal ISA. So you're better off just leaving it in your company bank account, and you'll be better off than withdrawing it and putting it into an ISA to get a tax-free small interest rate on that. There are also certain types of insurances that we have an IFA that we work with, and they are able to structure your insurance in a way that is tax deductible. So you might pay for your indemnity insurance, that's tax deductible from the business, but there's other things like life insurance that isn't. You might pay it from your business, but your accountant will just add it back for tax. But if structured in the right way via a company, then that can be tax deductible. There are also you could pay for your masters. That would be a tax deductible expense from your business. There's various different things that we can make sure we run through the company. They all receive a corporation tax deduction, and you don't have to pay tax to get them out. So hopefully you've all kind of seen when we circulated about today, we offered a free personal budget review. So that's the tool that we use to assess basically if someone's paying for something out of one personal pocket, which they could run through the business. Now, obviously everyone's circumstances are bespoke, but I don't think I've ever done this exercise with someone and not saved them money somewhere. So what we'll do following today is you will get an email from us, and it's just got a simple template, and it's basically just letting us know when you take that £5,000-10,000 a month from your business, where do you deploy that? Where do you spend it on? Because as accountants, we get to see the ins and outs of your business accounts, but we're a bit blind when we see that 10,000 go into your personal account each month. We don't quite know where that's going, and if we can help to improve how that's spent. Simon, I just wanted to touch on how limited companies really come into play when you're buying and selling. So one strategy that we use a lot with associates is we advise them to set up their associate service company. They receive all their income into the company. They draw out an amount that they need to live off each year, but they leave the remainder within the company. So that's only incurred corporation tax at 19%. They then accumulate that over a number of years, and then maybe 5 years' time, they're ready to buy their first practice. They can use that as a deposit, as a tax-free transaction. So it's very efficient. Also, if you're looking to buy a practice, we would always recommend that you set up a company, even if you've got no funds saved in it, so that you can get the finance in the company name. So if you're obtaining finance to buy a practice in your personal name or sole trader, you are making those repayments post-tax. You've already paid tax, and then you have to make your loan repayment. Whereas if the company loans the money, it's pre-tax. So that's easily tens of thousands of pounds of tax saved over the life of a 10, 15-year loan. There's also ways that we can look to reclaim taxes from HMRC that the previous owner might have paid. We also, as I mentioned before, we have a consultancy department. So we work with them to, if a client decides that they might like to sell in a year or 2 years, we work with the consultancy team to help improve the position of that business. I'm sure you all know that practices are valued on a multiple of EBIT. EBIT's just another version of profit. So if we can help them to improve the profit, then they're going to get a multiple back of that 4 or 5 times the increase when they come to sell. We also work with some clients who their strategy, they might realise in 5 years that they're going to sell. So instead of paying the tax to get the cash out now, they're quite happy to leave that cash accumulate in the company for 5 years. Then when they come to sell, they sell that cash pound for pound to the buyer, and that is basically taxed at the sale rate then, which at the moment is 10%, might be set to change, but it's certainly better than the 32.5% they would have paid to extract that. So there's loads of different little quirks and options that we can use when it comes to companies when we're buying and selling practices, which obviously the figures are usually quite large. So that's it from me. I'm just going to hand over to Simon now, who's going to talk a little bit about property tax planning.
Yeah, thank you, Hayley. I'm going to talk about some slightly more complicated aspects, but hopefully nothing too much. Well, I think one thing that we probably take from what Hayley said and what I'm about to say is that actually there is no one size fits all for anybody here. There's a lot of things we would probably recommend to most people, but they still need to be done carefully and properly to get the right answer for that person. So property tax planning is a classic area of that. Here in the UK, owning property is an aspiration. It's something that everybody kind of assumes they will do one day. First of all, they'll buy their house, they'll probably buy a business, they will probably look to own the property that goes with that business. They might then want another house, a holiday house or just a rental property. It's a fantastic source of tax for the government. And over the years, they've slowly chipped away at the advantage of owning property to increase the taxes on it. Properties are always taxed on the person who owns them, whether the person is an individual or whether the person is a company. It's the owner of the property who pays the tax on any income it generates and any value it's generated when it's sold. So, if it doubles in price, you pay capital gains tax. When you sell, if you make a rental income, you pay income tax or corporation tax on the profit. Historically, every single accountant you speak to would say, absolutely, you should own property personally. And the reason for that is because property is always increasing in value. So not only as an individual, you pay income tax on the profits each month or each year, rental income, and then it increases in value, you sell it, you pay capital gains tax. Actually, if you did that in a company, that cash would then belong to the company. And if you wanted to extract that, you would then pay another 30% tax, dividend tax. So you've got a double tax problem. That's just really bad. But a couple of years ago, they introduced a change to the rules for mortgage interest. So individuals owning property no longer get higher rate tax relief on all their mortgage interest. Now, that could have a massive impact on income taxes that you pay. It could cause the rest of your income to flip up through the abatement, and everything just starts to increase really rapidly on the tax side of things. So most accountants suddenly turned around and said, okay, we absolutely just put your property in your company. Your company doesn't have that mortgage interest restriction. It pays less tax on its profits each year anyway. Do that, sell your company, sell your property to your company. Just solves the interest problem. We'll crack on. What it doesn't solve is the double tax problem. That property is still going to increase in value. You're still going to want to sell it one day. You're still going to want to get that cash out of that company somehow. You're still going to then pay 30% tax on the profits. That's before you even get started with, well, actually, how do you put your property that you own personally into a company? You can't just change the paperwork at the land registry because there's a mortgage. Probably the mortgage company aren't going to be happy about you no longer owning the asset, so the mortgage has to be sorted out. There'll be stamp duty because, as Hayley said at the start, companies are a separate legal entity to you. So it is a problem to solve. And like I said just a moment ago, there is no one-size-fits-all answer, but there are ways that we can optimize the situation for people, depending on the rest of your circumstances. It's just an area where you've got to pay attention to. Group structuring is another area I'd like to talk about. You might have heard us mention this before in some of our blogs that we've put out. If you receive that, you've heard the word group a lot, but you might not know what a group is. Well, in its most simplest form, a group exists when a company owns another company. For a lot of you, if you've got a limited company, you'll own that yourself, but there might be a number of reasons why you might want multiple companies, and you might want a single company, what we call a parent company, as you can see in that diagram, owning a couple of other companies that do different things. There's a number of reasons why you might want to do that. It has a number of benefits. With a company, everything the company owns is owned by that company. That might sound like an obvious thing to say, but what that means is when you come to sell your business, which most people will look to do at some point, if you're looking to sell the shares of your business, then when you sell the shares, you will sell everything that business owns. Now, if that business also owns your rental property or another business that you don't want to sell, you've got a problem, because when you're selling those shares, you are selling everything. You're not just selling business A and keeping business B. A group lets you do that. So you could have another company, you could have the two businesses in separate companies, or the investment in a third company, and just pick and choose which ones you sell. A group also lets you accumulate all your funds into the single place. So as business one, business two, rental property, as they make profits, whether it's from selling assets or from trading, they can pool all those funds into the parent company, which is then your source of income. You don't have to worry about building a plan to say you'll take £1,000 a month from A and 2,000 from B, and you're going to pay for this from there and that from there. It's just all pulled into the parent company. That's where you draw your income from. Any cash that builds up in there can become your pension. It can be used for investments. You can keep it there to pass it down to your children. It gives you the flexibility that a company gives you in a more simple way, with further flexibility for selling in the future and divesting of assets and businesses. It's a fairly simple concept, I think. And almost anyone can put themselves in a situation where they have a group, but if you do it wrong, you can trigger some unnecessary taxes. You could end up paying tax on the value of your business, even though you basically still own it. So it's really careful to get that done properly, and to pay attention to all the fiddly little tax rules that can kick in. But if you do it properly, it can cost you no tax at all. It's always a lot easier to do these things in advance. So if you had a single business and you were thinking of buying a second, actually let's have a conversation about setting up the group now before you buy that second, rather than splitting them out in the future. Or if you know you're going to, if you've got yourself in a situation where you have two businesses in a single company and you're going to sell one in the future, but you think you might keep the other, actually let's have the conversation now about getting that ready, because sometimes there just isn't time. Some tax rules need 5 or 6 years to avoid triggering taxes that you don't need to pay. One option that is also available with a parent company or with a company that is not quite fully in the group is to form a company in such a way that it's exempt from all the reporting requirements that normal companies are required to report. So most companies have to put some accounts at Companies House, and these are publicly available. There's any number of reasons why you might not want public information saying all the assets that you own. It could be any number of reasons. You don't want your employees to know you've got excess cash in the bank, for example. So we can set up a company that lets you pool assets in such a way that they can be passed tax efficiently to your children, later down the line, but also so that they're kept private. And it's not about doing anything that's unusual. It's uncommon, but it's completely within UK company law. It's just not utilised very often. Some other taxes. So I didn't feel these needed their own slides, but just a few points worth talking about. So VAT, and in particularly VAT and facial aesthetics. Quite rightly, most dentists think that they don't have to worry about that because dentistry is exempt from VAT, and that's absolutely correct. Where you are delivering healthcare, you can rely on a particular exemption and not have to charge VAT on what you're doing. Dentistry falls within that, so there's no need to charge VAT. And actually, if the work you're doing is exempt, you don't have to worry about VAT at all. The risk area is cosmetic work, and as facial aesthetic work becomes more and more popular amongst dentists, that comes into the fold as well. So there is always a risk that there is no healthcare benefit to facial aesthetic or cosmetic work, or that there's no primary healthcare benefit. In most cases, there will be, and in a lot of cases, there will be a mental health benefit to having cosmetic work done, and it's perfectly reasonable to use that as a healthcare argument and get a VAT exemption. However, whilst that might be possible, some of the time HMRC are not going to believe your notes if every single one of them says there was a healthcare exemption because of mental health benefits. They're just not going to believe that. They'll take a sample, they'll go through the ways they work through people's affairs if they inquire into them. You could have a problem if you're doing enough work, enough cosmetic work to trigger the VAT threshold. It's just something to be aware of if you are doing a lot of facial aesthetic work. Fortunately, there was a recent tribunal case on it last year, I believe, in the courts, where it was proven that the healthcare exemption is relaxed a little bit if you are providing the service at in a regulated environment. So a dental practice actually regulated by the CQC, that counts. So actually, it's a lot easier now to say I didn't need there to be a healthcare benefit because I'm a dentist, I'm registered with the GDC, I'm operating under CQC regulation. The VAT exemption applies. That's really good news for dentists, but it is, there is still a need to be careful. And there are things we can put in place to mitigate that risk, such as maybe doing the facial aesthetic work through a different different group company. Again, it depends on circumstances, it depends on volume, and we can always have a conversation if you're concerned. IR35, you've probably heard a lot about that over the last couple of years. IR35 is a set of rules that exists where an individual does a job via a limited company that serves no other benefit. So there's kind of two types of limited company. There's ones that might own a practice, and there's ones that just see you doing associate work. So as you can see in the diagram, you've got the dental practice, you've got the individual. In the middle is a company called a PSC, a personal service company. There's a set of rules that looks at certain circumstances that says the only reason that company exists is so that you're not employed by the dental practice. Now, that's important for tax purposes because you pay a lot more tax and national insurance as an employee than you do as a self-employed individual or via a company. So they brought in a set of rules a number of years ago to basically stop that from happening. It doesn't legally stop it from happening. It just means you pay the same tax as if you were an employee, which is bad for both the practice and the individual. The rules only apply in certain circumstances, and the person who, or up until recently, the person who chooses whether to apply the rules is the individual who runs the company in the middle. Now, this is a hot topic because we're in the middle of these rules changing. So a few years ago, they brought in a change for the public sector, which said, actually, we're going to take the obligation to make this decision away from the company in the middle and put it on the dental practice. Actually, it wouldn't have been a dental practice because public sector, but they are mirroring these rules in the private sector. It was supposed to happen in April this year, April just gone, April 2020, but it's been pushed back because of COVID to April 2021. So as at April 2021, any practice who employs the services of an associate via a limited company has to decide whether to apply PSCs, whether to apply IR35 to that and tax the individual at employment rates rather than just paying the cash to their company and letting them sort themselves out tax-wise. It doesn't apply to everybody. There's some limits on it, some financial limits on turnover of the practice, which means it will probably only apply to the big corporates, you know, Bupa, Dentex, Portman. There's a number of others, obviously. But actually, we just don't know how they will react. We know when it was announced and when it was due to come in April, the banks reacted really badly. They all just turned around and said, we're just not going to use consultants via companies. We're just going to employ you. Tough luck. That was really bad for the industry. I don't think any of the corporates will make that decision in the dental world. I think the knock-on effect to the industry would just be too big. What we started to see when these rules were set to come in earlier this year is a slight change in working practices to make sure that you do hit the boxes that confirm you are self-employed. But the risk is that they don't have the time or the skill to actually apply the assessment properly. So instead of sitting and assessing the arrangement they have with every single associate, they might just say, tough, we're not accepting it. No limited companies. Like I said, it seems unlikely. There were calls for reviews to the rules. So you might have heard about these rules before and that they were reviewing them. They have had a review. They've not made any changes to the rules. They've accepted that they think they're fine. They are coming in April. Hopefully by then some of the corporates would have kind of shown their hand and we'll know a little bit more about exactly how they're going to apply this. Another aspect of this that is connected is self-employment status of particularly hygienists and associates. Now, your employment status is not based on what you decide, it's based on how you actually work. Dentists have always been fortunate enough to have an exemption between HMRC and the BDA, a dispensation that dentists operating under a contract that mirrors the BDA's terms are definitely self-employed, and therefore the employee rules don't matter, which feeds into IR35, because if you are definitely self-employed, then you don't have to apply IR35. But like I said, the risk there is that they're just not going to look at it properly. It's really important that if you have got that BDA contract with your associates, that they are mirroring those contractual arrangements. It's no good having a contract that says one thing and doing completely different. You have got to be doing the self-employment status will mirror the actual facts of the case, and it is looked at on a case-by-case basis. There has recently been a case on that, I think late last year, that was in dentist's favour. So it did say, yes, the associate is self-employed. So they looked at it even with the dispensation in place. There's a fear amongst HMRC that the contract is not being mirrored in practice. It's just being used as a cover-up, and people are basically should be employed. That's a big fear at HMRC. There was rumour of the dispensation being revoked back in April. Doesn't seem to have happened. We're not aware that it has been removed, but like I say, it's important to look at it on a case-by-case basis. That's okay for associates, because not only you've got a dispensation, but you've got case law on your side, which says, dentists working under the contract are self-employed. But actually hygienists, I think we've always had a view that hygienists are quite possibly incapable of being self-employed. They just don't work with the autonomy needed to be controlling themselves as an individual. They are being controlled by the practice and then should be employed. Just an area of risk and something we'd be happy to discuss with people. Upcoming changes. Obviously, everything that's been going on for the last 6 months or so has cost the country a lot of money. Never mind, any other costs, emotional costs, cost of life, etc. The support the government has given to businesses, rightly or wrongly, has cost a lot of money. Borrowing is up, spending is up, tax has got to go up, basically. It's almost certainly happening. It's been alluded to a few times by the government. We don't know what's going to happen. We do know something's going to happen. Actually, it was announced this week that there's going to be a review into capital gains tax, whether that's fit for purpose, whether the reliefs that exist are appropriate. All sorts of rumours as what that might mean. Will they scrap the private residence relief? That means you don't have to pay tax on selling your house. Who knows? That seems a bit far-fetched, but we just don't know. What we do know is capital gains tax used to be at 28% instead of the 20% it is now. So there's every chance they could reverse that drop that happened a few years ago and push that back up again. I wouldn't be surprised if it does go up. Entrepreneurs relief, that's another part of capital gains tax. We know they dropped the lifetime limit to which you can claim entrepreneurs relief from 10 million to 1 million. Again, I think they might go further. I think if they don't scrap it entirely, they might drop that down to 100,000. And these changes will come at the next budget in the autumn, I think. We don't have a precise date, but that's when anything that happens is going to come in. The Chancellor referred to some changes to national insurance when he was talking about the self-employment support. He was saying how he was alluding to not everybody paying the same amount, so they can't all get the same support, which leads me to think maybe there's changes to national insurance coming. As Hayley mentioned earlier on, you pay a lot less national insurance as a limited company owner than you do as a sole trader or as an employee, so there might be some equalisation happening there, which doesn't override the recommendation to be working through a company. So everything I've just kind of said might on the face of it look like it's going to narrow the gap between a company and a sole trade, but one thing we know with companies is that they will always give you more flexibility than you get as a sole trader. Sole traders are taxed on the profit they make. They have none of these choices to make about withdrawing funds or saving in the company or buying in the company. It's just not an option. So whatever tax rises come, we still firmly think that companies are still going to be the way forward. I don't know if we've had any questions through from Lucy.
Looks like we've had one. So someone said, what's the process to set a limited company up? So it'll depend if you're an associate or if you're a practice. So if you're an associate, We kind of have a service that guides you through what you need to do and kind of takes care of the kind of paperwork side of things, making sure you're registered with HMRC. But in practical terms, you need to go along and set up a limited company bank account. You need to get a new contract with your practice that's in the company name, and switch your direct debits over so being paid from that bank account. So it's quite straightforward. You can usually do it well within a month. If you're incorporating a practice or an existing business, it is more complex. Kind of, we're more heavily involved to advise you, and there's kind of more tax pitfalls we need to avoid. But that tends to take, I don't know, 2-3 months. It's usually limited by how long the bank take to set your bank account up and switch the card machine over, and CQC registration needs to be done, bits and bobs like that. But yeah, something that is easily done, and we tend to take most of the burden. So there's a few tasks to do with a business incorporation, but substantial savings. So it pays off.
Yep, great.
Don't think we had any other direct questions. Like I said, if you do have anything that's kind of specific to you that you'd rather discuss in private, then feel free to get in contact with myself or Simon. You'll be getting an email from us tomorrow, so just respond to that one, and we can line up a conversation. Thank you all for participating and listening.
Thank you.
Thanks.